Welcome to the Market Outlook session for December. The topic for today is what to expect from your investments going forward. So let's just get straight into it. What we have over here is we've calculated the PR ratio. The PR ratio is, for instance, if you look at the large caps that we're pointing to right now, is 2.5 for the large caps currently. What that means is that for every 1 rupee that a large cap company makes in India, people are willing to pay 2.5 rupees for that. If you look at the historical average, people were willing to pay 2 rupees for every 1 rupee that the company made. Uh, so it's clearly that this presentation clearly shows that the markets are definitely overvalued relative to the past. And in this one specific case, it's overvalued by approximately 22%. So what this means is that historically we've always told you that if the companies grow at about 10%, eventually the prices of these companies will also grow at 10%. But because the markets are overvalued, what you'll see over here is if the companies grow at 15%, in this scenario, we will end up making only 12%. That's for the large cap space. For the mid cap space, if they grow at 15%, we'll end up making 12%. And in the small cap space, if they end up growing at 20%, we will end up with approximately 20%. So the valuations, according to the PR ratio, don't seem too overvalued when it comes to the small caps. But definitely when it comes to the large caps and the mid caps, they seem to be quite overvalued. So the question now comes to where do we at Guardian see, in terms of earnings, where are we going to land up in the next 4 to 5 years? Right? Historically, if you look at the large caps, the earnings of these companies have grown at 12%. If you assume, these low interest rate scenarios and the last 5 years haven't been great for any of these companies, let's assume that the economy doesn't kickstart like crazy where these guys are going to make 20%, but say 15%. If they make 15%, we end up with a CAGR of 12%, which means that any money that we put in today, if those companies grow at 15%, we will end up with an average return of 12% per year, 4 or 5 years down the line. On the mid cap space, we think, yeah, maybe these companies will also grow at approximately 15%, so we'll end up at 12%. Keeping in mind all your financial plans are done with an estimated 11%, so it does still give us some amount of buffer. And on the small cap side, if these companies grow at 20%, good high quality small cap companies should grow at between 18 to 20, 23 to 24%. And should that happen, we will end up making approximately 20% a year over here. So the idea being that the idea was to just tell you that things are expensive. They're expensive because one of the reasons is bond rates are low. So if you look at this slide, uh, can you just imagine India has 100 rupees in bonds, 100 rupees in real estate, and 100 rupees in equity. And if bond rates fall really, really low, all that 100 rupees moves into real estate and equity. And as a result of this additional money that's thrown into these segments, they seem to be quite expensive. Right? In time, at some point, bond rates will also rise, and as they rise, money will get pulled out of here, and valuations will most likely go back to normal. So the idea being was to tell you what you should be expecting over the next couple of years of any amount of money that's put in today, and that we just need to be a little careful because prices are high, but they could stay high for many, many years to come. And in spite of that, we still don't end up doing too badly. 12% return is, if you have low inflation, is we should be quite happy with that. If you have any questions, please reach out to us directly and we can go through these slides with you. Hope you have a nice day. Take care.